Hello traders, Gary Wagner here, approximately 11 o'clock, making it 4 o'clock in New York City on Friday, finally last day of the week, 25th day of the month, that is January 2013, and this is the daily report for gold and silver, our weekend review. Before we begin today's show, I do want to talk about a feature that I have added to the actual program itself. Let me go ahead and bring up what our website looks like so that those who go to a daily or our weekend subscribers will be able to utilize and take advantage of this feature that we've added. I realized that after talking to a few subscribers that not that many people were aware that we've actually implemented it. And that is this. If you go to either the daily report for our daily subscribers or the weekend review, you'll notice that the video starts off that page. There's then the opening letter, market forecast, and at the bottom you'll see this chart gallery, and that's what is the feature that I want to talk about. If you go ahead and click that, and I change that each and every day, if you click that and then click through, you'll see that there's 9 charts on the report for this day. This was the 23rd. And then if you just go ahead and click them, what you will see is all of the charts that I have used in the show. I am duplicating them in high definition so that you can kind of go through them. They'll go full screen if you're viewing the video full screen. Now to the show. Continuing on this corrective action, fairly, I'll call it moderately strong down day in the precious metals market, specifically gold and silver, because platinum and palladium are actually up today. Gold currently trading off about $9 on the day, as you can see, 1658, 1657 in that area. The low has been 1654.90 with a high of 1673.30. Silver also showing a downside momentum, off about 1.27%. Gold's off about 0.5% on the day. 3104, that's our low. 3192, that's our high. And as you can see, our current print is roughly at 3119. 3119, as I said, putting it down about 40 cents. We are looking at our 60-minute candlestick chart. This is the spot market of gold, and it is in Japanese average format. Starting the show with this to really illustrate the kind of sell-off that we've had and what kind of clues we might have had just preceding that. Of course, if we go back to the beginning of the year, and that's right here, 12/31, first day, second day, third day of the new year. That market had been moving up, of course, but it stalled, and it stalled at a pretty critical area, because the area that it stalled at was right below 1700. That's this mark right in here. As you can see, 1700 is just above that. Now, of course, the market came down, pretty severe sell-off, because it goes from about 1700 down to about 1625. And at 1625, it began a nice, methodical, slow move up. And when I say methodical, what I mean by that is we were pretty much trading within this channel, as you can see right in here, as the market oscillated. But as it oscillated, you could see a series of, well, this one goes a little bit below, but you could see a series of higher lows. Of course, it broke through that here, and then it really made a stab, or its first attempt to go and take out 1700. But as you can see, it was absolutely unable to do that. You can see that right in here. And so for a period of 3 to 5 days, the market really started trading within this channel right in here, in which it attempted on a number of occasions to take out 1700 or to trade at least near it, but was unable to do that. Now, that brings us to this current sell-off that we're experiencing now. As you can see, let's go ahead and enlarge this a little bit so we have a better idea. But you can really see when we enlarge this, the kind of resistance that it was having. And this resistance, of course, was just under 1700, really 1695, 93, 94, right in that area. But even on a 60-minute chart, once we were unable to take that out, we began to see this downside pressure. That downside pressure really is right in here. And the best way to look at it was that when we had a couple of lows in place, and these were at around 1685, you can see this low right in here, right here. And then, of course, as the market came down and tested it, it really ran through it pretty quickly and pretty hard. That's why over, say, the last 3 trading days, I had talked about the fact that if we see weakness in the market, we are going to exit our trade. We'll exit it with a small profit, but a profit nonetheless in both gold and silver. And that was one of the things that really led me to the belief that this market could not hold or maintain the sustained rally that we had. And then the next question, of course, becomes, well, if we're looking at this market, where can we expect it to go? And for that, we want to take a look at really what our subcount has been. And we've been under the assumption here that this is our wave 1. We are now in wave 2. Now, the wave 1, the wave 2, these are all found within an intermediate third wave. So it's a bullish up wave. It's in an impulse cycle, but this is a corrective wave found within it. So really what we're looking to do at this point then is to run a basic Fibonacci retracement from this last rally, take it up to the high that we got. Let's go ahead and carry this over. And really the most critical number typically on a wave 2 is going to be a 61% retracement. And when we look at it in that way, let me go ahead and move the numbers over to the other side. You can see that 1653, we're at 58, but that would be a 61% retracement of this move up. Now, why is that important? Well, if we're under the belief that what the market's going to do is run through a period of, call it peaks and valleys, or in essence, basically move up one step, or up 2 steps, excuse me, down 1 step to move up, it would then have to, on this next impulse wave, meaning wave 3, that would have to take us above 1700. But obviously, prior to getting to that point, we've got to ascertain at what point this market is going to find some support. Now, typically, and let me go ahead now and enlarge this now that we've put in those markers, but typically in a marketplace that runs up a certain distance, we will typically see it retrace approximately 61%. That is a standard Fibonacci number that we look for. Let me go ahead and try to line these up as best I can, of course. And so as you can see, when we do that, we're very, very close to that point. Now, does that mean that that should wash out what we're looking at? Well, when we look at any kind of a pattern, what I would expect to see would be some sort of an A, B, and a C. Now, the fact that we've already reached 61%, I wouldn't be surprised to see something like an A, a bounce up from here, a B, and then a C in terms of some sort of a flat. And why would I look for a flat? Well, the reason is we're already at 61%. Now, the next level, if it does break through there, is going to be 1643, and that is our 76% retracement level. It's a little bit steep. Typically, we don't see that, but we'll have to see how the market unfolds. Now, as we kind of step back, and the way I'm going to do that is by looking at a daily chart in the market, we can talk about a really critical area, and that's 1630. You know, on the shorter term charts, we looked at 1634. That whole area, when we look at it, we remember back to last year, that was the point in which the market really broke out, because what we had seen prior to that was really a ascending bottom and pretty much what's called a flat top. And that was how the corrective nature kind of unfolded. And then we had this utter and beautiful breakout that really took us up to what? Well, this triple top up here at 1800. And so once the market hit that, was unable to take it out, of course, we went into our corrective phase. And my belief was, and still I believe that that will probably hold true, that what we basically saw was an A, a B, and then a C. Now, once we were in our C, of course, the one thing that we looked at was the fact that if we look at these tops right in here, absolutely, we were above these tops. You can see that this bottom matched quite eloquently in terms of being able to find it being supportive. And from there, of course, we went into our basic subwave count, this being wave 1, this being wave 2. Let's go ahead and mark those in. This would be 1 right here. Market comes down, this would be 2 right here. And then what we're looking at right now is our third wave. Sorry about that. It's done with a mouse rather than my pen. I should have used a pen. But on this third wave up, I would expect that to be characterized either by a 3 or a 5 count. So 1, 2, 3, 4, and 5. And it's my belief, though, that 5 really needs to test or threaten at least this area. If not, the other possibility, of course, is that as this market completes its corrective wave right in here, so what we're looking at is 1, 2, and this is our intermediate count. Now then 3 could be something like this, 1, 2, and it could basically on a 3 count just go to test this one top at 1750, because that top's really got to be taken out, obviously, before this major top at 1800 gets in play, and could stall somewhere in there. And then, of course, it would be corrective wave 4, and then our 5th wave is what's going to come over here, but really needs to begin to challenge some of these record tops, because once we go into our 5th intermediate wave off of this major 5th, we should almost certainly go to test that area. However, we're far from that point now, and the big question now is, in this corrective area, where will that end? And we are at a 61% level, and because of that, I am going to look to see if we get some sort of a truncated, or the possibility that we get basically a flat, meaning the market comes down, moves back up, and then comes back down to retest it. The other possibility, of course, is rather than an ABC, to have a compression triangle. We'll have to see how that unfolds next week. Now, in terms of inflicting long-term damage on our charts, looking at a weekly chart, straight candlestick format, and what concerns me when I look at this chart, we had this market coming down. I realize this is a very, very long-term weekly chart, but we had the market coming down. It finds its low. This is the beginning of the year. This is the end of last year right here. This candle represents really the first part of 2013. It forms a base. It finds supportive activity right in this area. We then, for the last 2 weeks preceding this week, of course, really saw it characterized by green candles, meaning it closes above where it opens that week. And last week especially, we really made it back. This is that $1,700 point. You can see that right here. But what concerns me is that the current candle has reached a low below the low, at least going into the close of the prior week, last week. And that absolutely has some concern, because are we going to see the market continuing down, or will it just kind of find a base again in this area and then move back up? We'll have to wait and see. But I do have genuine concern with this lower low on a technical basis. Now, we're still continuing to stand back to kind of look at the big picture, and that's what this chart does. It's a 2-day chart in Henkin format. But when we look at it through these eyes, at least these series of lows here as I carry it up, we're still well above that. I am concerned with the lower low, there is no doubt, but I don't believe that we will inflict any kind of long-term damage unless we really break through this longer supportive price point based upon trend analysis. So as far as my count goes and as far as I'm concerned, I still believe that what we are witnessing right now is our major 5th. I believe that the sub count that we talked about is probably correct. and I believe that we will see higher pricing once we complete this consolidation phase, this wave 2. It's really a subcount found within our intermediate wave. Our intermediate count, of course, is 3, and the 3 is really just beginning, and that's why it's a little bit harder to see here. This being 1, this being wave 2, and now we're in wave 3. And as I said, wave 3 should at least go to challenge that 1750 area. Somewhere along the line, we get a wave 4, and wave 5 should absolutely challenge this record top. That's our current assumption that we're working with, and I still think that that is a valid assumption. Now, as for silver, you know, a candle that burns twice as hot will burn twice as fast. I believe a line from Blade Runner. And really what we're seeing with silver is on the upside, when this market is in defined rallies, silver tends to outperform gold in terms of percentage gains. The same is true on the way down, though, and that is that we get greater percentage losses, of course, as that market goes down. Now, this market, just as in gold, seems to have found a closing area just below, but right about at that 61% retracement level, as you can see right in here. And of course, this is a daily candlestick chart. And what we are really looking at is this particular move down. And when we do that, we get our different levels, of course. And as you can see, the market has really stopped at that 61% retracement. Now, that's a long view of the market. The other way to look at it, and the other retracement that we would use, would be to take it from the bottom to the top. In other words, what we want to look at is simply, as this market moves up and rallies, when it comes down, 61% would take you to 30.47. We are just closed below that 38% retracement level. And so that's what we really want to see within the marketplace itself, because what we might see is really an ABC, but we'll have to see how it unfolds. But we'll see if it finds support here and actually begins to bounce up. That would be our A, our B, and our C. But this is going to unfold over the next week, week and a half. So we'll really have to determine at what areas we find support and then act accordingly. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.